A very good evening, everyone. I'm Cindy, Executive Director of CFA Society Malaysia. Warm welcome and thank you for taking the time to join us for our Future Leaders Mentoring Program, Financial Modeling Masterclass with Financial Modeling Institute. So, financial modeling is a key skill in finance. It helps with analysis, decision making, and is widely used across roles in investment and corporate finance. We're very fortunate tonight to have the Financial Modeling Institute with us to share their insights. Before I introduce our guest speaker, just a quick note on the agenda and housekeeping. So this session will run for approximately 1.5 hours, comprising just over about an hour of presentation followed by the Q&A segment, which we will end with a photo session. Or I may interrupt Ian in between to take a group photo when the bulk of us are in, okay? So this session is recorded and the recording will be made available at our YouTube channel at a later date. So may I kindly ask that all participants here keep your microphones muted throughout the sessions. You are welcome to ask questions, but please feel free to post them in the chat box and we will address them during the Q&A segment. So now it is my pleasure to introduce our speaker. Ian Schnoor, CFA, CFM, is the Executive Director at Financial Modeling Institute. He founded FMI, which is the world's only financial modeling accreditation program with candidates in 120 plus countries. Over his 20-year career, he has taught financial modeling to over 25,000 professionals globally, founded the Marquee Group, and created the financial modeling module for the CFA Institute. He also teaches at Queen's University, where he's been named Professor of the Year twice. So with that, I will now hand over the session to Ian. Ian, all yours.
Wow, it's a very kind welcome. You're embarrassing me, Sini. Thank you for your very kind welcome. It is really great to be back. And I've got a couple of my colleagues here today who I'd like to say hello as well, because we've got a very busy and full room today. I'm going to be moving very, very quickly, but I got a couple colleagues that will say hello. If you have comments and questions, you can put them into the chat, and one of my colleagues might be able to answer you in the chat, and I can also, answer it verbally in front of everyone if that makes sense. So, David, you want to say hello first, and so everyone will know who you are if you're chatting with them?
Yeah, for sure, Ian. Hello, everyone. Absolutely pleasure to meet you all today. My name is David Manes. I'm Partner Relations Manager here at FMI. Help support global partners around the world, and really excited about this webinar. If you have any questions whatsoever, feel free to drop it in the chat. I'll be more than happy to answer it.
Amazing. Thanks, David. And my other colleague here, Paul Coulomb. Paul, do you want to say hello and tell everyone what you're up to?
Absolutely. Good evening, everybody. My name is Paul Coulomb. I'm academic partnerships at FMI, as well as institutional partnerships. So I'm in business development, and I set up many programs for our foundations and AFM courses in academia. So again, yeah, please reach out on chat, and I'll do my best to answer any questions.
Amazing. Thank you. And so it's an honor to be back here for another webinar on this, what we're calling a financial modeling masterclass. Let me go ahead and share my screen then now, so that you can see what's going on. And as if you've never been to a webinar with me, if you have not, if this is your first webinar with FMI with me, you will discover that we like to keep the webinars very interactive. So I'm going to encourage you to use the chat, to use the different ways to interact with us. We're going to be chatting with you. If you have questions, we want you to be able to get answers. And by the way, as Cindy mentioned, the session is being recorded, and any of the files that I share, any files I show you, we will share them with you after, so you'll have access to the slides and to the model. Now, chat. Great. So first of all, we always like to know, where is everybody? Now, I know that you're going to be, most of you will be in Malaysia. I was telling Sini, I was in KL a few years ago. I had a great time. I hope to come back sometime soon. I would love to know, where are you? If you're in Malaysia, can you go to the chat? If you're in Malaysia, let me know. Are you in KL or somewhere else? And if you're outside of Malaysia, let us know. So let's go. I'd love to know. Feel free. There's a lot of people here. I'm watching the chat now. Where exactly? I was in Cyberjaya, Putrajaya. Where are you? We got in Penang. Great. Where else? KL, Perak. Where else are people? I want to know exactly where you are. KL. Okay, Petaling Jaya, great. Where else? Johor, fantastic. Selangor, great. KL, Selangor, great. Okay, so people are all over. In Jakarta. Oh, we got someone in Jakarta. Fantastic. Wow. Okay, great. Anyone else want to share where you're joining from? I love it. Okay. Beautiful. Well, that tells me you know how to use the chat and you're able to interact and share responses and feedback. Beautiful. Well, let's get started here. So today we are going to have a financial modeling masterclass, and let me tell you exactly what we're going to be doing here. So here are some notes. I'm going to share my notes file with you as well. David, I assume you can see it. It flipped right to my notes. Okay, great. So what are we going to be doing here today in this in today's session? I'm going to start by talking about financial modeling best practices. We're going to talk about some critical financial modeling ideas, model flow, managing assumptions. I'm going to show you how to build scenarios in a model. I'm going to talk about some key modeling ideas, and then we're going to end with a high-level discussion on some valuation here. You can see I have another sheet, and we will talk about some high-level valuation concepts. Now, I'll be honest, I could talk about valuation for 8 hours. So this is going to be just a bit of an introduction, a taster into some valuation and modeling concepts. But I hope it gets you excited, and I hope it makes you think about wanting to spend more time in financial modeling and valuation. Okay. So let's go back to my slides for a second. As you heard very quickly, I'm Ian Schnoor. I'm not going to spend much time on this. You heard my bio already. I have spent my whole career in financial modeling, teaching modeling, doing financial models. I had the honor of building the new practical skills module. That's a mandatory part of the CFA program. Do we have any CFA candidates? Is anyone going through the CFA program right now? Do we have any candidates that are going through right now? I'm curious. You can raise your hands if anyone's going through it. Not right now. Okay, one, right? I see one or two. Maybe some of you already have your CFA charter. Well, if you go through it, you'll notice that at this point, you have to do okay, we've got say you're level 1. If you're in level 1, did you have to do a practical? Everybody has to do a practical skill module now in the CFA program. And if you do the financial modeling one, that one will be with me. And I hope you enjoy that. So, and just very briefly about FMI, we are the world's only financial modeling accreditation body. Think of FMI like CFA Institute. We offer rigorous exams, learning materials, video tutorials, and exams so that people can really become excellent financial modelers. If you really want to become an excellent financial modeler, we would love to welcome you into our AFM program. We have a huge community online, and people work very, very hard to become great modelers. And so we have a special discount offer, which I will show you later if anyone is interested in participating. So let's dive in then into some financial modeling best practices, and then we're going to get into the valuation, after about 45 minutes or an hour or so. And what I want to start by talking about is that financial modeling is its own discipline. It's not just working with accounting. It's not just working in a spreadsheet. Financial modeling is its own discipline. How many people here, can you guys raise your hands? How many people, or go to the chat, how many people have ever built a financial model of a company from scratch by yourself? When you see me look this way, I'm looking at you. I have a big screen. I see all your names. I have all of your names here. I can see you all, which is nice to see you all. How many of you have built? Okay, Xiong Lim has, yes. And Zhang says yes, learned from some other books. Great. Anyone else? Who else has done some financial? Okay, Jing said did, but not so good. Yes, Ting for sure. So let's talk about, many of you have not. I know a lot of you are students, so you probably haven't. If you want to work in finance or even accounting, great. If you want to work in finance or accounting in your career, you will need to learn financial modeling. And today is your intro, your teaser to get you started. And I hope it gives you some, excitement over what it is. Now, financial modeling is a discipline. To be a good financial modeler, you need lots of different skills. You need to know Excel. You need to know how to design. You need to understand logic. You need to understand accounting and finance and business operations. So let's talk about this now. First of all, I like to always ask a group, what is a financial model? What is a financial model? And it's very, very simply a forecast. Okay, that's it. If anyone ever says to you, what is a financial model? It's just a forecast. That's it. All we're doing is trying to forecast a company's financial statements into the future. And how many years? I'm looking over. When you have to, if anyone here has ever done a forecast, how many years into the future do you typically do your forecast? Can type a number in the chat. 5 years, right? Zhang said 5 years. That's very common. 5, 5, 5, 10. Someone said 10, 5, 5, 3 to 5. Good. 5 to 10. Yeah, I love it. 3 to 5. 3 to 5, yeah, 10 years. That's a common range. I agree with all of you. Can I show this to you? So yeah, for sure. So what I would say is 5 to 10 is the most common range. We refer to this as the model's periodicity, but it's not the only range. Some people forecast longer, some people shorter. 5 to 10 years is the most common range. But the bigger question is why? Why do we forecast? Why do we forecast? And I will tell you that financial models have become the most important decision-making tool in all of finance. So many decisions are made in finance based on our financial models, our forecasts. Can you guys go to the chat? What kind of decisions do finance professionals make based on you make a 5 or 10 year forecast so that you can make what type of decisions? Can I see you in the chat? What kind of decisions are people making with yeah, great. I love it. Good. So Zhang said valuation. Excellent. Good. Valuation decisions. Brilliant. What else? M&A. Yeah. Excellent. Azri. Beautiful. M&A. Great. What else? Lots more decisions. What kind of decisions are people making? Ah, great. Amir. Funding. Good. Funding. Risk taking. I love it. Right. Tarandev, excellent. Pricing, these are great comments. Budgeting, yeah, Iqbal, great. Super. Asset acquisitions, valuation, Rachel, beautiful. You're all right. So let me show you some of the key decisions people make with models. People make decisions around credit, evaluating credits, loans, credit risk for sure. People make decisions around investments. Should I buy or sell an asset? Yeah, target prices for sure. People make research forecasts to set up, they want to pick a price target for a company, and that is based on your forecast. Valuation decisions, security analysis decisions, M&A. Some of you wrote M&A, leverage buyouts, LBO decisions, budgeting, operational budgeting, headcount, spending on marketing. These are decisions we make. And then, of course, risk management, sensitivity. So there's lots and lots of decisions people make with their models. But there's a problem. You know what the problem is? The problem is someone earlier said that they made a model and it wasn't very good. Well, that happens, unfortunately, with everybody. The problem is that most financial models are a mess. Most financial models don't work very well. So many spreadsheets don't work. They're often filled with errors and they are hard to understand. And if your model is a mess, it makes it hard to make a decision. Can you guys raise your hands? Has anybody here opened a spreadsheet in Excel and you saw a formula that was so long that it wrapped around and around and around? Anyone ever seen, raise your hand, has anyone ever seen a crazy Excel formula that went around and around and around? Yeah, Nurfaz says yes, right, Jing? Who else? Who else has seen the crazy long formulas in spreadsheets, right? Yeah, pretty common. And if you haven't, you will, right? I can see a bunch of you raising your hands. Great. It's not ideal. It's not optimal. We shouldn't do that. It's not ideal to do that. because it makes it hard for people. Yeah, ref, right? Zarul says lots of ref errors. It's a mess, and it makes it very hard to have confidence to make a good decision. So let me tell you this. When you ever think about a forecast model, I want you to know that a good forecast model must work in two very different ways. Number one, it has to work electronically. What that means is that in your spreadsheet, every single formula must make sense. Electronically, every formula has to make sense, number one. And number two, a good financial model has to work on paper or a PDF. It has to feel like a presentation because many senior professionals, many executives want to review a model on paper or as a PDF. It's very important. A model has to be a powerful communication tool. It needs to tell a story. And can I tell you a secret? I'm going to tell you a secret about financial modeling. I think a lot of you are younger in your careers, which is great. I love it. Here's a secret about financial modeling. Nobody will tell you this. Nobody will tell you this. Financial modeling is one of the best leadership development tools you will ever see. People who become strong modelers become excellent leaders because when you can build a strong model, it means you understand a company, you can communicate it, you can tell the story, you can create confidence, and then people want you to get elevated throughout an organization and in your career. Very important. And as a result, I really encourage you to think about elevating and growing your financial modeling skills. Really invest in your financial modeling skills. It will help you throughout your career. And that's where, if you're interested, FMI can help you do that. Now, let's take a look here at a model. I want you to see. So here is a financial model. This is a financial model that we use at FMI, that we use in our learning curriculum. Anyone who does the AFM program, this is the sample model. Anyone who is in our first level AFM program learns to build a beautiful financial model like this one from scratch, from nothing, from a blank spreadsheet. You'll notice here I have a cover sheet. You'll notice in the model I have an executive summary that has the answers. You'll notice that there is a page of assumptions. All the assumptions are here in the model. We have some general assumptions, operating assumptions, assumptions around interest rates, cost assumptions. It's all clear. You'll notice we have assumptions about capital expenditures and working capital, very important issues for the company. So we have assumptions. We have scenarios. We have a lot of scenarios that I will show you how to build, and the model has a switch. You can choose between a base case, a best case, and a worst case. I'm going to show you in about a half an hour. I'm going to show you how to build this. I'm going to show you how to make this. I want you to know how to build a beautiful scenario page. It's so important. And then we have the actual model itself. And you'll notice it's a 5-year forecast, right? Does everyone notice it's a 5-year forecast in the model? I have a revenue. This is the revenue forecast for 5 years. Underneath it, I have the company's operating costs. This is a 5-year forecast of their variable costs and their fixed costs here. And then I have an income statement, right? Do you see this? I have a forecast for the company's income statement for the next 5 years. Starts with revenue, works its way down to net income is the income statement. As we come down nicely, I have the cash flow statement, a forecast, and then the balance sheet. And you can see the model goes on and on. What I hope you feel like, as I showed it to you, I hope you feel like this model is clean and organized. And I hope it seems logical and presentable. A model has to be a nice storytelling tool. It has to create confidence. And I hope you feel like it so far looks logical. But as I told you, a model doesn't need to just work in Excel. It has to be something that you can print on paper or as a PDF. That's how many senior executives will look at it. So this model also works. I can print it. I can print this model onto paper or a PDF, and I'll show it to you. Here it is. Do you want to see it? Here is the exact same model as a PDF document. You'll see it's 15 pages, 15 pages. Let's go look at this model on paper. If you print it on paper, there's a cover page. Underneath it, there's the executive summary. Then I have all of the assumptions and the inputs in the model here. You need to understand how this works, right? The inputs, the assumptions. You see, it feels like a presentation. My scenarios, my upside case, downside case. Again, the revenue forecast, the cost. Do you notice something? Do you notice that when I go down, do you notice that when I go up and down, there's a title on every page? Do you notice that I have a subtitle? Do you notice that every page has page numbers? And there's space on the left and on the right and at the bottom, right? It feels like a financial presentation. And people sometimes say to me, people say, hey, Ian, did you make this in Excel or in PowerPoint? This comes right from Excel. Your Excel spreadsheet gets built to do this. And anyone who can do this is a very, very powerful modeler who can tell a great story about this business. Now, what I want you to see here is that's what the model looks like. And as I said, as a reminder, anyone who can do this, anyone who goes through the AFM program becomes an expert at building this. And on our exam, the AFM exam, you have to build a model like this from scratch. You have 4 hours on the exam to build it up. It's a skill that will benefit you for your whole career. Now, a model like that, the model I just showed you, doesn't happen by accident. You have to plan it. You have to make sure you properly plan it to make sure it works well. It's very important to plan your model because there's an optimal flow. A good financial model has to communicate like a presentation. How many people, raise your hand, how many people have made a PowerPoint in the last year? Raise your thumbs or your hands if you had to do a PowerPoint presentation for work or for school in the past year. I want to see how many. Sure, Rachel, right? Wait, who else? I'm sure many of you. Who else? Who else, right, has had to, right? Sini did, right? Who else? I can see a lot of thumbs going up. Amir, right? Azri, Dev, look at all these. Fatana, great. So many people, right? Isaac, good. Cayenne, I can see your names. Beautiful. Sure you did. And what you probably noticed, good. I'm sure you remember when you made a PowerPoint presentation, you made it in a certain order. You have to make it in a certain way to communicate clearly. So in the same way, a model has to flow in a logical way. Now, what's the optimal flow in a model well, you just saw it. A good financial model, this is an important takeaway. A good financial model must have a cover page. It must have an executive summary, right? You need to have a cover page so that it feels like a presentation. It's nice to have an executive summary because the summary tells you the answer. It tells you what is the answer to this particular problem, this model. Are we looking to get a valuation? What's the valuation? Is it credit analysis? What is the credit analysis telling us? So a good model has to have a cover page, an executive summary, but also needs to have assumptions, okay? The assumptions tells us, how did you get there? What decisions did you make to build your model? And by the way, what you might have noticed is that in a good model, our numbers are a couple colors. We have blue numbers. I can see blue numbers here. Look, there's a lot of blue numbers. Here, all these numbers are blue. And in the model sheet, we have more numbers that are black. Some numbers are blue, some numbers are black. Does anyone know why? Does anybody know why a good model uses different colors as a convention? Some blue, some blue. Yeah, Zhang, blue is inputs, right? Blue is, he said, hard-coded, and black is formula. Excellent. That's a very common, right? Very nice. Good. So that's a very, very common convention. Black are calculations, and blue are, I'm going to call them inputs. You type them in. These are numbers that you typed into a cell. They're blue inputs, black calculations, and blue are for inputs. So you need to have assumptions and you need to have a scenario page. A scenario page allows you to manage uncertainty. And I'm going to show you now how to build that. We also then need to have the engine. The engine is where all the calculations work. So the engine is where all the formulas and the financial statements are, and that's this. This is the engine. The model sheet is my engine of my model. All the formulas, all the calculations live right here. So you can see a cover sheet again, and a summary, assumption page. I've got scenarios, which I'm going to show you how to make it, and then the actual model itself. This creates so much confidence for your client and your boss when you can deliver a model in this organized, logical way. So it's sort of a very clean, and just this, think, if you take away this, take away these skills, it will already help you if you're in school or in a career, understand how to build, a beautiful forecast. So let's come back here. So what I want to share with you now, I want to show you a great Excel skill about how to keep, I want to show you a really nice Excel technique. How do you keep your assumptions up front? So I mentioned that that in a good model, we need to have our assumptions up front. It tells the reader, how did you get there? What decisions did you make? How did you get to your answer? What inputs did you use? That's what the assumption page does. But what I will tell you is, and it's helpful because people want to know what your inputs are before they look at the calculations. Again, in the model, I've got a cover, a summary page, and then all the assumptions are here. But many financial models do not have an assumption page. Many models do not have an assumption page at all. So, by the way, if your spreadsheet does not have an assumption page, where do people put all the inputs? These are all the assumptions and the inputs. Where do people put all of the input data if they did not build an assumption page? Can someone go to the chat? Have you seen this before? It becomes a big problem. Where do people put all of the input cells in their models if they don't have a really nice page up front here to show all of them? So many models don't. Yeah, maybe there's an index, right? In the formulas, right? Good. People put their assumptions inside the formulas. So inside the formulas, every formula in the model sheet has inputs, calculations. It's scattered everywhere. Exactly. It's very important to show your assumptions up front because people want to know what are the inputs before they look at the calculations. It's very helpful. So here I want to show you a really great, how many of you like working in Excel? How many of you like working in spreadsheets and playing in Excel and using Excel tips and tricks? Raise your hand if you enjoy spending time. You came today to a modeling webinar, so I hope you like Excel. So let me know if you enjoy using Excel spreadsheets and playing around. I see a bunch of thumbs go up and some hearts, right? Excellent, great, good stuff. Well, you should. It is a very important tool that you're going to use in your career. I want to show you now a really great feature in Excel called Excel's watch window. It lives under the formula menu here. You can see formula menu. There's a great feature called the watch window, and I'm going to show it to you. Let's go take a look at it here. So let's imagine you have a model and you have assumptions. Okay. Let's imagine you have assumptions in your model, right? So I've got all my cost assumptions, and here is an assumption for the company's raw material cost, $226 per unit. Okay. The raw materials are going to be $226 per unit. Fine. But what happens if your client wants to look at a higher number, or your client wants to look at a lower number? If I make this 250, look what I did. I'm going to change it to 250, the input. But what did that do? What did that do to my valuation? What did that do to my net income? What did that do to my EBITDA? I don't know. When I change an input, what does it do to the answers? I'm not sure. I can't see it. So here's what I want you to think about doing. I want you to go to the formula menu. I use my Alt key. If I press Alt, and then you'll see there are letters. I'll say, now I can press the letter M for formulas, Alt M, and then the watch window is the letter W. Alt M W opens up the watch window. Again, look here. The watch window lives under the formula menu watch window, Alt M W. Now, look what I get this box. The box says this is a watch window. It allows you to watch formulas in other parts of your model. So I'm going to say, let's add a watch. Okay, let's add a watch. And I'm going to go to the model sheet. Let's go to the income statement. And I want to watch 3 years of EBITDA. Do you see that? I'm going to watch my first 3 years of EBITDA. and I'm going to click add. And then I'm going to watch another watch. I'm going to add, let's go do another one and add. Let's watch the first 3 years of net income. You see that? And when I click add, the net income, I now have 3 years of EBITDA and 3 years of net income inside my watch window. And this is beautiful because now if I'm testing my model, if I'm playing with my model, if I make, look at this, if I make my raw materials 250 and I press enter, look what happens inside the watch window. It's done. Everything changes. I can see what's happening deep inside my model when I play with something up front. I can make it 240 and everything change. I can make it 200. Look what I make it 200 and what happens to the values. Everything goes up. So it's very powerful to play with a number and see what that does to your calculations much later in the model. Who's going to try this? Who is going to try this feature in your own Excel spreadsheet later? Who's going to try? Great question from Muhammad. Great question from Muhammad about the camera function. Let me know. I want to curious to know who's going to use this feature. Let me know raise your thumb if you're going to try it. I want you to use it in Excel. It's a very important feature. Now, he's asking, how is the watch window more powerful than the camera function? It's not. It's not more powerful. That's another great feature, Muhammad. That's a really great feature as well. The camera feature. I don't have it open on my screen right now. It is another great feature you can take a look at. The only difference, the only reason I like this one a little bit, Muhammad, is with the watch window, I can watch some numbers here, net income. I can watch some numbers on the balance sheet way down here. I can watch some other numbers, working capital. I can watch things all over the place. When you do the camera, you're taking a picture of a range. So it's harder to look at stuff in lots of places, but the camera feature is also great. If you like using it, then by all means use it and try this one as well. Now, what I want to now show you is oh, Jeff is here. Look at that. I just got a message. Jeff is here. Jeff, I am very pleased to hear that you're around. We're half an hour in. Welcome, Jeff, my colleague
Hello.
and friend in Malaysia, one of the world's members of our Global Leaders Council, and it is great to have Jeff show up in the webinar here. There you are. Maybe
Thank
later
you,
we'll.
Ian. It's okay. I've been hiding inside the room for the half an hour ago.
Oh,
So
you're hiding. Oh, Sini said she didn't know if you were coming. She forgot to tell you about it, but I am really glad that
no.
that you're here. Fantastic. Well, I should show very honored. We launched a last year or just earlier this year, a couple months ago at FMI, we launched a financial model global leaders council. We took 60 of some of the best financial modelers in the whole world, and we've put them together in a group, and we're going to create some great research on the future of modeling. And we have people all over the world in the Americas region, Europe, Asia, Middle East and Africa, and Australia. And Jeff is one of our honored members from Malaysia. So thrilled to have him, an excellent financial modeler. Great resource. So thanks for joining here today, Jeff. This was a little commercial. This was a little mid-webinar commercial for Jeff Tan. So thanks, Jeff, for being here today. Cindy, do you want to do a
Thank you.
photo
Ian?
at some point? Yeah,
Correct. I was going to interrupt you all now. Not
great.
to
I
steal
know
Jeff's thunder.
we have to do a photo time, guys. I knew that it was a commercial break, and then I'll get back and I'm going to show you how to build a scenario page and when we come back, but I know Sini likes to do a picture. So,
Can we have everyone turn on their cameras?
you got to turn your camera on. Got to turn on your camera. So,
Just to share with the audience as well, Ian, Paul, and David is dialing in from Canada, which is 12 hours behind. So it is not often we get them on screen. So yeah, please turn on your cameras so we can take a good picture.
where's David? There we go. Camera's on. Amazing.
Which,
Look
by
at
the
all
way,
these.
is also David's birthday today. So everybody can wish David happy birthday.
Can we wish David happy birthday? David's birthday today. You can wish him happy birthday.
Thank you so much.
Get these cameras coming on. There we go. Thank you. Wow. I love it.
Okay,
Let's
after that you
let's
wait, let me check my team. Just give us a cue.
Okay. If you guys are ready, then can just smile and I will take a few screenshots while we're at
you
it.
want to I think you got some more cameras coming on if you want to give it
Yes.
look at that. Look at all these great faces. It's nice
Okay,
to see
please
everybody.
do join us and open your camera, turn on your camera so I can take a few screenshots. So, guys, you can smile
Okay,
for
no
I think
worries.
a few seconds.
You
Keep
can
your
smile.
smiles on so that I can
Those of
capture
you that are shy,
them.
it's fine.
Okay, yes. Okay, please. All right. And I think my team will also help me to take some photos as well. Okay. Keep on your smile still. Okay, great. Thank you. Okay, wait. For a few more seconds, I'm gonna take a few shots. Okay. All right. 1, 2, 3. Cheese.
Okay.
Okay. We're good.
I
Okay,
love it.
Ian, all yours again. Thank you.
Okay. Thank you,
And
everyone.
the cameras quickly go off. Isn't that Jeff? Isn't that amazing? Like the cameras, bang, they go off very quickly. But that's okay. Thank you for turning them on. This society likes to do a photo, and I think it's great that we get a photo. So thank you for doing that for them. Let me go back and share my screen because what I want to do now is I want to show you a really great. I want to now get back in, and I've got the chat open here. Just got to open up my windows. Great. Okay. Um, and let's come on back then. So what I was telling you is I showed you how to manage assumptions. Now I want to show you how to manage uncertainty. We are living in a world. Oh, look at that. Look at all those cakes, David. David got so many birthday cakes. Wow, flying across the screen. Maybe we can have a piece later. Let's talk about this. I'm going to show you how to manage uncertainty in models. I want you to get a sense for what models are and how to manage uncertainty. And then after that, we're going to move on to some discussions on introduction to valuation. So first of all models have to deal with uncertainty. All companies have uncertainty. All models should deal with uncertainty. And that's because some assumptions. So you already, remember I showed, let's go back to the model. I already showed you that we have assumptions in a model. Well, some of the assumptions in a forecast are easy to make. For example, if you know that the company has a tax rate of 35% or 20%, that's easy. It's easy to forecast. You know exactly what the tax rate will be. If a company has interest rate on their long-term debt and it's fixed rate debt, then that's an easy assumption. You know exactly what that assumption will be. If the company has depreciation expense and they depreciate their assets over 30 years, that's easy. You know what that assumption is. Some assumptions are very easy to make in a model. They don't change much, a tax rate, an interest rate. But some assumptions in models are very hard to forecast because they can change a lot. They can change a lot over the forecast. Examples are things like economic variables, price of oil, price of gold, exchange rates, commodity prices, inflation, growth rates. Some assumptions are very hard to make because they can change. They can change a lot. So for these variables in a financial model, you need to have multiple options. You want to have more than one case, multiple options in the model, and you want to have a base, a best, and a word. At least you can have more, but it's nice to have more than one choice to show your client and your boss more than one possibility. And so for every time you ever build a forecast model, you should have a scenarios page to capture these hard variables, the difficult variables, and we call them the key drivers. These are variables that are hard to forecast, and I'm going to show you how to do them, and then I'll come back and summarize it. So you notice in the model here, I have a page called a scenario page. Again, we're going to send you the model after so you can play with it. So you'll notice that I have cost inflation. I don't know what the cost inflation will be exactly. Cost inflation, sales prices, and sales volumes. I don't know what these will be. So I have a base case, a best case, and a worst case. And what I want to show you now is how do you make this page? How do you build it? Because it's very powerful to know how do you make this in any model. And I will tell you that step one is to make yourself a large rectangle. You can see here, so for cost inflation, I need to have a base case, a best case, and a worst case. What will the cost inflation be? I don't know. So this is my assumption for the base case. This is my assumption for the best case and for the worst case. How do you get these values? How do you get these values? I don't know. Do some research. Talk to your client. Right? Talk to your client, do some research, and read a research report and try to decide what do you think is the most likely for inflation, the best case outlook, the worst case outlook, and you'll notice these numbers are blue. And because they're blue, of course, they are inputs. So the large box, this large rectangle, you're just going to type in, you see, these are inputs. You're going to do some research and enter in values for the base, the best, the worst. That's it. Very simple. Now, for step number 2, I'm going to move this for a second. You need to have a switch. You need to have a switch. Now, a switch is just a number. You see, this is also blue. It's also blue, and it starts off with a number. We're going to start it with the number 1. It's simply the number 1. It's a switch. And what is it switching? What's it controlling? Well, it's controlling the live case. This is a good question. We is asking, did I just change the font color with the keyboard shortcut? I did. And I will show that to you in a moment. You have a very good eye, mister. He was watching carefully. He noticed that I did this. He noticed that I had a number and it was black, and then I made it blue, and I made it red, and I made it yellow. It's really important to know how do you change colors quickly with the keyboard. And it is a great skill. You'll notice that I have some buttons at the very top here, a black button, a blue button, a red button, and a yellow button. And I access these with my keyboard. I think I have, there's actually, I'm actually going to post I don't have time to go through all of it here, but what I will do is I'm going to share you a link to a video that I did a couple of years ago, and we still get a lot of people watching this video. So I'm going to post a link. If you want to watch, if you want to see that, we just click on that now and then watch it later. It's about 10 minutes, and it's going to show you exactly a very powerful skill to quickly change colors in Excel. It's a great skill. And if you want to see what I'm up to in LinkedIn, I often post videos and articles so you can see here what I'm doing. Yeah, check that out. Let me know after how you like that. But watch it later. Don't watch it now. But if anyone wants to see that, you can just click on it and then you'll have it. It's on my LinkedIn feed. And I have stuff that I post there. Now, let's get back to the model. So step one, you put the numbers into the blue assumptions into a box. You do research and you decide what do you want the assumptions to be. Step number 2, have one cell that's a number 1 and it's your switch. It's just going to be the switching mechanism. And then step 3 is the live case. Now the live case is a formula. You see there's a skinny row. This is a skinny row and it has black numbers. It's a formula. Now, most people, many people use an if statement. Many people here use an if statement, and it looks something like this. This is what people often do. Jeff knows it's not a great idea, right, Jeff? Not a great idea to use a giant long if statement because it looks like this. But I'm sure I've done it in my past. Jeff, you probably did this as well at some point, right? A long if, and you say, right? It goes, if this guy here, if that switch is equal to a 1, then click on the first option, right? That's what I'm trying to say. If that switch has a 1 in it, then take the first one. But otherwise, if the switch is equal to a 2, then take the second one. And otherwise, put a 3. That will work. Does anyone know what this is called? Does anybody know in Excel what it's called when you have an if inside another if, an if with an if with an if? What's that? There's a name for a nested, right, Zarul? A nested if, an if-else tree, or I'm going to say, look what I'm typing into the chat. You could call it an embedded. People call them nested ifs, embedded ifs. Here's a trivia question for you. Does anybody know how many times you're allowed in Excel to put an if inside an if inside an if? Type it in take a guess. Take a guess. Jeff's going to give a prize to anyone who knows the right answer. Does anyone know what we got one answer, 256, 15. Keep guessing, guys. There's no harm in asking. There's no harm in asking. What's your guess? How many times can you put an if inside an if inside an if? 365. Well, the answer is actually, very good. Wehan, did you just Google that? It's 64. That's correct. The answer is 64. Yes, he did. 64. Great. Is how many times? And that's a disaster. That would be a disaster. Okay. To have 64 nested ifs here. It would be a disaster to have 64. So you don't want to do that, having an if inside an if inside an if. So what's a much better option here? A much better option is to use a great feature here called Excel's choose function. This is one of my favorites because it's so simple. Look what the choose function does. The choose function simply says, where's your switch? And then where are your choices? I'm going to do it. Let's leave the if statement here. A choose function just says, where is your switch? And then where are your choices? Choice 1, choice 2, choice 3. Where's the switch and where are your choices? It's a very clean, elegant, beautiful tool. I like it because clients like it. Clients like it because it's so simple. It says, so you could either use a very long if, an if statement would go long, 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 or a simple, tiny, elegant choose. A choose says, where is your switch and where are the choices? Guys, every model you ever build should have a scenario page, and this is a great way to build the scenario page. Now, raise your thumb. Who's going to try using a choose function? I want to see here. Raise your thumb if in your spreadsheets, if you are at school, if you're in work, if you're at school, if you're at work, who is going to try using this choose function? Oh, I see 20 hands, thumbs going up. How many? Let's see some more. I want you to try this feature, please. The thumbs are going up. Great. Because it is a very powerful. The question from Wehan is it faster than an offset? Is it faster? And when you say faster, I'm not sure if you mean the processing speed or the faster to build it. There's nothing wrong with an offset. The computationally efficient. Honestly, I get asked that a lot, Wehan, computationally efficiency, because that's true. Some functions compute faster than others. I usually don't, I'm going to be honest, I don't usually pay attention to that. You know why? It's measured in like microseconds, and you only see a difference when you have hundreds or thousands of formulas. If you're dealing with a model that big, you think you've got other issues that you're dealing with here. So, you can search it up quickly. If you have massive Excel spreadsheets, you probably need to be looking at Python or something else anyway. It's pretty rare. It's pretty rare to hit the limit. My guess is if one of them is going to slow you down, the other one will as well. It's at the margin. An offset is fine. An offset also works. It's more complicated though. An offset function says, where is what's called a reference cell? An offset function, first of all, needs 5 different things. It says a reference, rows, columns, height, width. There's a lot more. It's a lot more complex to use an offset function. It can be. So an offset function says, give me an anchor cell. Now, my anchor cell can be, let me start here. If you want to use an offset, that means where's the beginning cell? Where should it start from? So let me just use this. Let me just for this purpose, tell it that my anchor cell will be this little skinny cell here. That's my reference cell. And then it wants to know how many rows down. How many rows down should I drop? How many rows down? I'm going to actually say drop down 1 row, but I don't want to type in a dead number 1. So I'll use my switch. I'll say, look at this reference cell, drop down 1 row and move over 0 columns. That's all. So it's actually pretty simple here. The offset says, where's your anchor cell, how many rows down, and how many columns over. Right now, that's a very simple function, no problem. But offset functions can get very complex. So if you use it, just be mindful that there's a lot more it can do. I like to choose because it can never get more complex. But you choose. You use whatever you like. You can use an if, you can use a choose. So I'm going to say better to use choose, or you can use offset, index. There are options, but these ones definitely get a lot more complex, okay? Now, the last thing I want to show you here is this. So now you know how to build. If I change it to a 2, look, if I make it a 2, if I make my switch a 2, now my skinny row is lifting up it's picking up the best case, and the best case is the live case that goes into the model. And if you make it a 3, now my skinny row is picking up the worst case, and that is what is building the model. The model is now looking at the worst case. So it's a very flexible way, right? The model looks at this row. The model is always picking up whatever is in the top skinny row. It's so powerful to include this in your financial models. Now, the last thing is this, and then we'll get into some valuation discussion, is I don't like having this number 1. I don't want to have this number 1 sitting here. I don't want this number 1 of just exposed and available like that. I don't want that number 1 because it's confusing. The number 1 doesn't mean anything, right? Does everyone see here? The number 1, if I go to my model on paper, look, when I show my model on paper, you don't see that number 1. I'm not looking at the number 1 here. What I'm seeing instead is this drop down. And I want to show you how to build, because that looks like a piece of software. It looks like a switch that you can control. I don't want my boss to see this number 1. So how do I get rid of that? Well, what I'm going to do is I need to go to my developer menu. Okay. I need to open my developer menu in Excel. However, you might not have it. In fact, let me go to my notes. If I go back to my notes, first of all, I told you that there are 3 steps to build a scenario. Number 1, we did this. I already showed this to you. You're going to enter the assumptions. Step 2, you're going to have a number 1 as your switch. And then I did this for you. I already showed you. You're going to, let me just indent that over, right? Then I showed you, you're going to have a formula to run the live case, right? You're going to use a choose or a lookup to run the live case. I showed that to you. But then I said, we want to build a switch to control it. I want to show you how to make that switch that shows an upside case, a downside case. It's on the developer menu. Here's my developer menu, but you might not have it. It might be off. So how do you turn it on? To turn it on, you go to File, Options, Customize Ribbon. File, Options, Customize Ribbon. Watch this. You go File. Okay, I'll give time. Look where my cursor is. File. I'm going to go down to Options. And then I'm going to say Customize the ribbon. And you must turn this on. The developer option might be off. If it's off, turn it on. Turn it on once and it will always stay on. And then you'll have the developer menu on your screen. And once you have it, you can click it. And then look where I am. You click developer and then insert. I'm doing this quickly, but the video is being recorded. So you can watch this video again later to help you. And by the way, if anyone wants to join our AFM program, we go through all of these skills and hundreds more. All of these skills get covered for anyone who wants to become an excellent modeler. So you click developer, you click insert, and then you're going to click on the combo box. You're going to click on this button here that says combo box. And then it allows me to draw. I'm going to draw for you a giant combo box. I just drew it. It's a switch. I'm just drawing it here. And now I'm going to right click on it. and say, let's format it. Let's format this control. Okay, so I go to my drop down, I right click and say, let's format the control. It wants to know two things. It wants to know two things. It wants to know my input range and the cell link. Input range, cell link. The input range means where's the range of words? There is my words, and the cell link means where is the switch? Where's the actual switch? So again, the input range is the words that you want to see in the dropdown, and the cell link is which cell should it change, should it link to. And then when you click OK, when you open it up, you get all the words in your dropdown. When you click base, it puts the number 1 in that cell. When you click on best, it enters the number 2. And if I click worst, it enters the number 3. All I have to do now is copy it, move it, and now I have a very powerful way to control my model. Clients love it. Your boss will love it because it makes it feel like a great piece of software. Okay, I hope you use that. So we are done the first part here on modeling. What I hope you're taking away so far is that modeling is a discipline. Modeling requires good financial modeling means you need to understand the structure, the design, the presentation. You need to have good accounting skills. You need to know how to design your model. You need to have good finance skills. You need to have good Excel skills. That's what modeling is all about. And I showed you a few things to help you think a little differently about modeling. I want you to leave today realizing that a model is much more than a calculator. A model is not just a calculator. A model is a beautiful presentation tool to help make a decision. And anyone who can do that, and I'm going to call on Jeff for a second, because Jeff, do you mind if I put you on the spot? Because you're obviously a professional financial modeler. Jeff's got his CFM accreditation. He's been surrounded. I mean, Jeff, can you just tell us, I mean, have you had experiences where a strong model allowed you to communicate with the client and helped you make good decisions with your client? I mean, do you have any, I don't know if you're on mute, but do you have any quick, example of how a strong model helped you do your job and create
Right.
confidence? I mean, you can hear it from me, or you can hear it from someone who does this for his career. I don't know if there's anything you can talk to.
Okay, thanks Ian for the opportunity. Sorry. I think I mean to answer this question, I think my little I think conclusions or spiritual opinions, 2 cents is like about presentations. I mean the models will definitely help you to actually present and communicate with the client. So I think one of the angles that before we start to plan and design the structure is to know who is our audience. Okay,
Love
if
it.
the audience is the entrepreneurs, then you have to follow the presentation on what they understand about the revenue structures. But if the your audience is private equity I mean investors, CFO, I mean that can be more sophisticated on it. But on and off, there are sometimes, right, you can also customize a different dashboard or different presentation to cater to group or different audience on that. So I think most important, I think, is to help you to present it and communicate it, right? I think
I
that's
love that. I love
yeah.
that. Know your audience. Of course, I love that. If you're working with entrepreneurs, you're going to focus on high level revenue buildup. If you're focusing with private equity, more sophisticated. I love that. But what Jeff's talking about is planning and thinking, right? And knowing how do you build confidence. And let me ask you one last question. Have you ever been involved in a situation with a terrible model? You didn't build it, but were you ever in a project where somebody built a model and it had errors and it was very stressful, right? I mean, surely at some point in your career, you had to work with a model that was probably not very good, right? Do you remember that experience ever?
Yeah, 100% had this kind of experience when you involved in this. Some of it is a legacy model you took from the management, and
Yeah.
sometimes they have no idea who is the owners, that you have
And
to
it's
rectify it.
very stressful, right?
Right. And sometimes there are some certain assumption that you couldn't change it, but at the same time, you couldn't understand where they're coming from. So this is actually the downside of complication, which I think you highlight just now, is that the best practice to keep the thing simple. So not avoiding any mistakes. Yeah.
Yeah. So thanks, Jeff. And take it from me and take it from Jeff. I mean, modeling is the tool and the skill and the discipline that's going to allow you to work with clients and professionals. They're going to have confidence in you if you can get through all the noise and build something clean and simple for their needs to make a decision. And when it's not working, wow, it's the most stressful thing ever. Everyone gets very upset. They don't understand. You have to make a decision, but the model's not working. And by contrast, the opposite is when a model's beautiful and working well. Oh my gosh, they're so happy with you and they want to always talk to you. They always want to work with you because you help them make a decision. So thank you, Jeff, for joining me for that to talk about that. It is true, and we have a young audience today. For a lot of people here are young. And that's why I so encourage you to think about investing in your modeling skills throughout the program. Now, what I'm going to do is I want to switch gears and talk a little bit about how we use models. And by the way, we still have a large group here today. I'll finish with this, but in case you want to just take a screenshot or you want to do a photo we have a very special and we probably have a link as well. I'll show it to you now. We have a special big discount for anyone who really wants to invest in your modeling skills in our AFM program. There's a QR code that you can take a picture of, and at the end of it, and then David's got a link. Don't worry about it now, but there is, we really want to help you become an excellent financial modeler. It will, I promise you, don't take it from me, take it from Jeff. It will help your career if you can really learn modeling. You know the nice thing about modeling too? The nice thing about modeling is it's like riding a bicycle. It's like driving a car. Once you can do it, once you know how to do it, you can always do it. Even if you didn't build one for a few years, you will be able to do it again once you get to a certain skill level, like your bicycle. If you don't ride it, you will be able to ride it again once you pick it back up. So how about we do this? How about we talk about now how models are used? Well, a lot of models, right? Right. And you saw many models are used to help make valuation decisions, right? So many models are used to help make I'm actually seeing a great question here. Let me look at this question and then we'll move on to valuation. Wehan saying, you mentioned that for complex models, we may move on to something more powerful like Python. However, the issue I notice, it's difficult to translate out of Python to something presentable to the board. Oh, great. First of all, yeah, I spoke about that very quickly. I would never use Python for a forecast model like this. I would never, ever use Python for a forecast. And even my friends who are Python experts would never use Python. Python is going to be used for data modeling. Like if you have a million rows of inventory or employee data and you have to analyze it and it gets very slow. By the way, that's because you asked me earlier about Excel functions and which Excel functions slow down a file. Usually files get slow when you start putting huge amounts of data, 10,000 rows of data, 100,000 rows of data. And as a general rule, if you've got 100,000 rows of data, it's often raw data and it can be used in another piece of software like Python. It's very, very rare to have a forecast model with 100,000 rows. It just doesn't, it shouldn't, it really shouldn't. It shouldn't be needed to have so much rows. So yeah, I mean, you need to figure out the right tool, of course, but for a forecast, I would encourage you to simplify it, build it just like this. Build something that is manageable that you can present to your board. I mean, that's how you're going to make it presentable. So yes, I hope it wasn't confusing earlier. A spreadsheet is still the best way to do a valuation forecast type of tool. Now, we use many models to help make valuation decisions. So let's talk about some valuation. Let's talk about valuation for 10, 15 minutes, and then we'll wrap things up. So first of all, one of the most important skills that anyone needs in working in business or finance is valuation. It is so important to have an idea how to value assets, companies, how to value projects, to make decisions. It's very, very important. I will tell you that if you ever get a job in finance, there's only two things, right? People do. Literally the entire world of finance, every single finance job in the world only does two things, believe it or not, only two decisions. So people who work in finance either are dealing with investment decisions. What should I invest in? How much is something worth? Which investments should we make? Should I buy this stock or that stock? How much is that company worth, right? If you work in the world of finance, you're either focusing on how much is something worth? What should I buy? How much should I pay for it? And then the second thing people want to know in the world of finance is financing decisions. Once you decide that you're going to buy something, how are you going to pay for it? How should it be financed? Are you going to use debt? How should we pay for it? Are we going to use debt? Are we going to use equity? What type of financing should we use? So the first decision we have to make in the world of finance is how much is a stock, a company worth? And then how are we going to pay for it? Let's say you want to buy yourself an apartment, a condominium, a house. The first decision you're going to make is how much should I pay? How much should I pay for that apartment? Is it overvalued? Is it undervalued? Should I buy that house? Should I buy the apartment? Should I pay for it? And then once you decide it's a good price, then you decide how will I pay for it? More debt, more equity? How am I going to pay for it? So anybody who works in finance is focused on one or both of these issues. Now, the first one is always the valuation decision. The first decision is always how much is something worth? And then the second decision you make is how should I pay for it? So when it comes to the first decision, how much is something worth? I want you to know there are really only two ways in the whole world. There are only two primary ways to value a company or an asset. The first is what we call relative valuation. And relative valuation means using other companies. If you look at how another company is valued, you can use that information to help you value your company, right? If I want to value one software company, I might look at another software company to see how they're valued. If I want to value a car company, a company that manufactures cars, well, let's look at another car company to see how they get valued. Okay, that's called publicly traded comparable company analysis, called trading comps. Or you can do what's called transaction comps. Maybe a company was purchased. Maybe a company was purchased in an M&A transaction. How much did the private equity firm pay, or how much did the industry player pay to buy a company? If you know how much they got bought for, then you know how much the other company is worth. This is called relative valuation, because you're looking at the valuations of other companies to see how much you should be valued. That's called relative. The second way, the only other way to value any company is what's called intrinsic, where you use the cash flows of that specific business. The most common method is what we call the discounted cash flow, a DCF. There are a number of steps. Or you could use a modified discounted cash flow, an LBO analysis, an adjusted present value. But what I want you to leave with today is that valuation is important. It's one of the most important decisions that gets made in the world of finance. How much is something worth? And I want you to now know there's only two fundamental ways to value any company. You can use a relative approach by looking at other companies, or you can do an intrinsic approach whereby you look at the cash flows specifically of that business. Every other valuation tool is just a variation. It's just a modification or a variation of one of this. Jeff, I'm sure you've done hundreds or lots and lots of valuations, and I know for a fact you've used all of these techniques because these are the techniques that are used all over the world. There are other techniques for valuation, liquidity analysis, breakup analysis, greenfield analysis, but they all effectively come back to the same principles that are into these ones, okay? Now, let's talk for a minute about relative valuation. If you have questions, feel free to put your questions in the chat, and I will stop probably in about 10 minutes, and then I'll see if you have questions. So let's talk about this approach, relative valuation. So what does it mean? Because I'm actually going to connect it back to a DCF in just a moment. So as I told you, relative valuation, this approach here, relative valuation means you're going to use a multiple or a ratio. A multiple just means we are using a ratio to value a company. It's a simple premise. It's a simple premise. All it is, it says, take the earnings of a company and multiply it by a multiple, a ratio. That's it. The two most common valuation ratios are a price earnings, PE, price earnings ratio, or the EV to EBITDA, enterprise value to EBITDA. Those are the two most common ratios. And in corporate finance worlds, enterprise value to EBITDA is more common than price to earnings. They're both used a lot, but enterprise value to EBITDA is going to be the most common. Let me show you an example. Let's look at an example of a price earnings ratio. I want to value a company. I have a company and I want to value that company. So what do? Well, I need to know what their earnings per share is. Let's pretend I found out that their earnings per share, EPS, last year was $3.25 a share, $3.25. Okay. Well, now what I have to do is I have to multiply it by a multiple. And I'm going to apply a multiple of, let's say, 18 times. And I'll tell you how I got that in a moment. I am going to use a multiple of 18 times. Now, what does that tell me? What's the price of the company? Well, I believe that if this company has $3.25 of earnings per share, and I believe the correct multiple, the multiplier is 18 times, and I multiply them, that tells me this company should be worth $58.50 per share. It's very, very simple. Let's now do it using the second approach, enterprise value to EBITDA. Okay, same thing. I need to know what was the EBITDA for the company. Let's say that let's pretend last year their EBITDA was 250. I need to apply a multiplier. And I'm going to use a multiplier of 8.5. That will tell me that the enterprise value, the value of the whole business, is $2.1 billion. $2.1 billion. This is fundamentally what relative valuation means. That's it. If you're using a PE approach, you take the earnings and you multiply it by a multiplier to get a price. If you're using EBITDA, if you're using an enterprise value EBITDA method, you take the EBITDA of the company, multiply it by a multiplier, and that gets to enterprise value. But it's much more complex than it looks like. What I want you to see, though, is just simply, and we'll talk about how we arrived at these values. Using this approach, using the PE approach, what this analysis suggests is that the fair value of this, if this is a public company, the fair value of this stock is $58 per share. I believe the fair value of the company is $58.50 per share. If the stock is trading at less, let's say 52, you might think it's undervalued and you should buy it. And if the stock is trading in the stock market at 65, you might think that it is overvalued. Let's talk about some general rules of thumb. First of all, you might be wondering, how did I arrive at these multipliers, these ratios? Well, as a general rule of thumb, price to earnings multiples are normally higher than EV to EBITDA multiples. In fact, that's always going to be the case. A price earnings multiple will always be higher than an EV to EBITDA multiple. Does anybody know? I'm going to go to the chat. I have a question for you. Does anybody know what a common range? What's a common range for price to earnings multiples? Not on high-tech companies or software. Just think about a normal traditional business, let's say a manufacturing business or a service business, or a transportation business. Does anybody know what a common range is for a price to earnings multiple? It's not usually 2. Most companies don't trade at 2 times. Most traditional companies don't trade at 97 times. You know what a common range? Yeah, good. I'm seeing some common ranges. Good. Wehan said 15 to 25. Zarul said 10 to 20. Yes, I agree with both of you. 10's a little low. You will see it, Zarul. You will see 10. You will see 10 times. That's pretty low. 15 to 25 is the most common range that I am familiar with. Companies tend to trade on a price earnings basis in that range. Look what I have. I forgot this, right? I had the exact same range that you did. This is a normal range is 15 to 20, but of course, some companies trade less. Maybe it's only going to trade at 10 times. If it's so, the stock might be at 32. Maybe there are definitely companies that trade at 45 times, but if you had to give it a standard common range, it's usually in this a price earnings range of 15 to 25. And enterprise value to EBITDA, a common range is 6 to 15, 6 times to 15 times EBITDA is pretty common. 8 to 12 is pretty common. So that's kind of normal in terms of a relative approach to valuing a company. Now, but as I just said, these ranges are for stable, mature companies. If it's a fast-growing business, if it's an early-stage, fast-growing business, the multiple can be a lot higher than this. It can be a lot higher. Now, how come, let me ask you a question. This is going to sound like a simple question. How come you're never going to see a price earnings of 1 time? How come a price earnings multiple would never be 1? If a company has $3.25 of earnings per share, if a company had $3.25 of earnings per share last year, how come you can't buy that company? Why can't you buy that company for $3.25? Yeah, right? I mean, Wehan says, because if it did, that would mean that you could, if a company had $3.25 in earnings and you bought the whole company for $3.25, it would mean you could get a return on investment in 1 year. You could earn your return in 1 year, right? Because that's 1 year of earnings. So obviously, in corporate valuation, we believe that companies will exist for many years. And when you pay a price today, that price has to reflect what do we think the earnings will look like and what kind of return will I get for many, many years into the future. And that's why you got to pay a lot more than 1 time. Even 10 times is low. 15 to 25 is going to be normal. How many times earnings you're going to pay to have what we would consider a reasonable investment. Now, let me just wrap things up here. In terms of choosing multiples. So how do you decide what the right multiple is for this company? Is it 15? Is it 18? Is it 20? Is it 22? Is it 24? I'm not sure. How do I pick the exact multiple for this company? Well, you look at, so I used multiples of 24 and 8.5, right? Or I was using 18. How did I determine this multiple of 24 and 8.5, right? I was using 18 at first. How did I decide to use these multiples? Well, it's pretty simple. How did I choose those multiples? Well, I did that by choosing and looking at comparable companies, looking at how other similar companies, because I might say, if there is another public company that is similar and they trade at 18 times, I guess I should also be worth 18 times my earnings. And that's the premise that we use. We look at what's called relative valuation. We look at other public companies. So let me just wrap up on this then. Why do people like relative valuation? Why do people like using multiples? Because it's quick and easy. You just take an earnings figure and you apply a multiple. Whereas for a DCF, you have to build a full model, you have to forecast cash flows, and then you discount them. And that typically tends to be why people tend to like using relative approaches. But I'll tell you a secret. The secret I want to tell you is that all valuation methodologies are the same thing. A relative valuation, when you use multiples, it's the same thing. It's just a shortcut. It's just the market's shortcut to a DCF. So all valuation approaches are really just a shortcut to a DCF. And what that means then is that the multiple is just the market's way of looking at all the future, right? It's just what I told you. The reason why I'm using a multiplier of 18 is because I think this company is going to exist and have cash flows for many years in the future. So effectively, I am pricing all the future cash flows and all the future earnings into the price today. And that's what that means. But it's nice to also do an intrinsic. It's also nice to do an intrinsic, a DCF valuation. And what I would say is when you do a DCF, you go to the bottom of your model. So it looks like this. Let me just go to the model and then we're almost done. How do you add a DCF to a model? If you had to build a financial model and then do a DCF, how do you do it? Very simple. You go to the bottom of your model. You go to the very bottom of your model and you would say, you would build another schedule called the valuation. You'd go to the very bottom and you'd add some rows and you would start to calculate what we call the unlevered free cash flows. I'm not going to have a chance to cover this today, but you can look it up online. What you're going to do is you're going to build up the company's unlevered free cash flows. Imagine here you had a row of the company's unlevered free cash flows, and then you're going to discount them back to today. That's the premise, and that's what would happen. You would build up the company's cash flows and take the present value of them. So you need to have in your model, you'll go to the bottom, you're going to forecast the cash flows. You need a discount rate. You need to understand the tax rate. You need to make some assumptions about the terminal year because the terminal year just represents from year 5 to forever, right? Like the terminal year says actually year 6. It will be from year 6. So the terminal period, remember we said most models are 5-year models? Well, but when you own a company, you can own it for more than 5 years. The terminal year represents what will the long-term future look like, and then timing. And that is the issues to consider. In today's webinar, I'm not going to get into how you do each of these. We could have a whole day just to discuss these, but for high-level premise, what I wanted you to understand is in your model, you'll go to the bottom. There's a lot of good videos and materials on how to calculate the cash flows. You calculate them, you make sure they're tax effective, and you discount them today. And then what I will tell you is, in a perfect world, if you value a company using a DCF and also value the same company using multiples, what should happen? This is the last comment. I'm going to wrap it up. In theory, if I picked a company, let's say Apple or Tesla or Google, if I value a company using a DCF and then I also valued the company using a multiple, what should happen? Exactly. In theory, the values you get should be the same or very similar. They need to be the same or very similar because you're doing all the same thing, because multiples are really just a DCF in disguise, right? You cannot value a company using a DCF and get a price of $100 a share and then use a multiple and get a price of $10 a share. Again, you cannot value a company using one tool and get a value of 100 and then value the same company and get a value of 10. The same company cannot be worth $100 a share or $10 a share. It's much, much too wide. You're using all the same information. So it means you either made a mistake or your assumptions are not consistent between the two tools. They need to generate similar values. Otherwise, you're missing something and you didn't capture them. So I hope you I hope you want to think about, it's possible the market's made a mistake. The market doesn't usually make massive mistakes like that I would say no. It's not the market, it's your decision, right? You're going to decide how to to apply the comps. Yes, the market might be pricing a stock low, but if you're valuing that company independently using a DCF and multiples, your two approaches should still get you to roughly the same answer. And both of them might tell you that the stock is worth more or less than what the stock market says. Okay, last question. I've got some. Let's take some questions. We're going to wrap it up in 5 minutes. Since Excel runs on could Copilot design the financial models for us? So the great answer is as of 2 months ago, as of February, Copilot can now do a pretty good job building models. It's not great, it's not perfect, but it can do a pretty good job. And if you look at Copilot, there are in my Copilot, I have ChatGPT 5.2, I have Claude Opus 4.5 and 4.7 in here, or you can let it choose automatically. Yeah. You can tell it, you can go to the prompt and say, hey, build me a model. You can do that. But I got to tell you a secret. You still need to understand how to prompt it. You need to understand. So I actually have been running webinars all over the world. Actually, one later today for CFA UK and another one tomorrow for a group in England, where I'm doing a webinar to show them what's happening in the world of AI and financial modeling. I'm going to show them how AI is building models these days. It does a pretty good job. But I believe your modeling skills have to be better than ever. You have to get even better at modeling, because you're going to have to understand the AI tools make a lot of mistakes. They do things in a strange way. You're going to have to know how to use them. So yes, Hafiz, I encourage you to use Copilot or Claude to build models. But I also encourage you to make sure your modeling skills are better than ever, because you're going to have to understand what AI is doing. Jen says, FMVA and AFM are on the market. What makes AFM a better option than FMVA? Well, it's not a better option. AFM is not necessarily a better option. They're very, very different. I know some people think that FMVA and AFM are similar. They're not. They're very, very different. FMVA is a great learning platform. FMVA, I like to think of FMVA, and I've heard people say this, it's like LinkedIn Learning for finance. FMVA, they have lots and lots of courses. You can learn about accounting, about finance. You can learn millions of things, and that's great. And you can learn lots. It's like a school. It's like an online school for finance and accounting. AFM is an accreditation. Think of AFM like the CFA Institute. At AFM, you're going to learn modeling, but you're going to become excellent at modeling because you're going to practice and you're going to practice. In the AFM program, you will practice and practice and practice and practice until you can build an excellent financial model from scratch. And you'll be able to do that for the rest of your life. Anyone who has an AFM badge is an excellent financial modeler because they had to work very hard and practice and demonstrate it on a 4-hour proctored exam. Whereas FMVA is a lot of great videos. You can watch the videos. Once you watch the videos, you can get your badges. But modeling is a skill. So just because you have completed a training course does not mean you're a good modeler. I've met lots of FMVAs that are not very good modelers because they don't go through the rigorous process. That's the difference. If what you're looking for is a training library with lots of courses, then that's a good option. But if you really want to be an excellent modeler and get tested and proven that with a great skill, we'd love to have you in the AFM program. Terry Dev says, I'm in year 2. What can I do to learn to build models as a complete beginner with beginner Excel skills? Why don't you well, we have a foundations program, Terry. Well, you can get right into our AFM program. We have lots of students that join the AFM program. The AFM program, we show you, I'm going to show you here. Actually, let me just go in for a second. We have, in our community, in the FMI community, there's learning materials. And so anyone who joins the AFM program gets access to the learning materials with 60 videos. I made all the videos. You can see it walks you through step by step by step how to build a beautiful model step by step, and then you practice. If you don't want to go through a rigorous exam, you can look at our foundations program, which is more of an introduction to modeling. And we offer our foundations program at many, many universities. If you email us, if you email our info, you can get our email address from the society or email us, go to our website, info@fminstitute.com. David, can you toss the email address into the chat? If you tell us what school you're at, we could potentially arrange. We have lots and lots of schools that use these programs. Leanne says, how much time do we need to put into the AFM program, over how long a period? When you sign up for the AFM program, and again, this is for anyone interested, this is the QR code or the link. When you sign up for the AFM program, the exams are offered quarterly. So the exam is every quarter. And when you sign up, and anyone here on the webinar gets a $200 discount if you want to sign up. When the exams are offered quarterly, and when you sign up, you can write the exam anytime in the coming year. So you have 4 options, and you can write the exam anytime in the coming 12 months. We get told by our candidates that they invest anywhere from 25 hours to 100 hours to prepare. So it depends on your prior level of experience. If you're a student and you've really never done much modeling and you don't know accounting very well or Excel, you might need 100 hours, but you will be an excellent modeler at the end. And someone who's done a lot of modeling would only need 25 hours. If we had a really great modeler like Jeff, if someone like Jeff had done a lot of models, they could do the AFM program in 10 hours because they've already built so many models. They'll do a couple practice exams and then they'll be ready. You see here in the materials, there are some practice exams. So most of your time, Wehan, will be spent practicing, and that's what's going to make you excellent. How long is the discount valid for? This special discount, I'm not sure. David knows the secret behind all of that. It's probably a week or so. I'm not sure, David, what the length is on that. May 15th. Okay, 10 days. You've got 10 days. I mean, you don't have to use it. Sometimes we have other discounts, but we're never sure. But if you want to get 200, that's a big, we don't usually offer $200 off, but if that's interesting, we would love to welcome you on board. So these are great questions. You also reach out to us. You see our email address, info@fminstitute.com. You can reach out if you have any questions. Anything else, or Cindy, do you want to come back and we can start to wrap things up? I know we're at time. It's been wonderful to be back here. Almost everybody is still here, which is amazing. So I'll see if you want to wrap things up.
Indeed. Yeah, I thought we will be doing the Q&A, but it was already running throughout your session. 90 minutes is not enough.
We did a bunch. We did a ton of Q&A. The last 15 minutes was all questions.
Yeah.
And I did. We covered a lot of questions as we went as well. So we did get through a ton of questions, which is great.
Yeah. So thank you very much, Ian, for sharing a lot with us today. Thank you as well to David, Paul, and Jeff. I hope the rest of y'all find that a very valuable session. And also, if y'all would like for us to organize more sessions like this, as you can see on screen, there is a QR code there. We'll appreciate your feedback so that we know what you all would like for us to bring back. I would love to bring Ian and team to Malaysia one day.
Oh yeah, for sure.
As you can tell, you've got a fan base already in Malaysia. So stay tuned if we do.
I appreciate that. I want to stay with. I'm going to stay with Jeff. I get a good discount rate on in his guest room, so I'm looking forward to it.
Okay, I'll make sure he has a bigger room for all of you. Okay,
Yes.
so thank you once again, all of you. To those at this time zone, enjoy the rest of the night. To Ian, David, as well as Paul, enjoy the rest of your day. And yeah, we will email out to everyone on the materials as well as once the recorded session is up and running at our YouTube channel.
We'll
So
send it
thank
out very
you again.
shortly. Thanks, Cindy.
Yes. Thank you, everyone. Good night. Appreciate your time.
All right,
See
great
you
to
next
see you
night.
all. Happy modeling. Great to see you. Hope to see you again soon. Take care.